They are not manufacturing anything at all. It's printing money. And this has been one of their weapons globally. The monetary system, the global monetary system, controlled by dollar and euro, has been used. Sanctions here, sanctions there, sanctions there, grabbing this account, grabbing that account, has been one of their tools. This is not going to continue indefinitely. And we need a new financial architecture globally, not controlled by euro, not controlled by the dollar, not controlled by other currencies.
Coming up today, an update on GameStop. Inflation data comes in soft. Is the US economy rolling over? Elon comes out on top, and the growing threat to the US dollar. Hey, what's up guys? Welcome back to the Daily Market Review. Big shout out to everyone who hits that like button every day and helps to keep me motivated making these videos. And I've got another interesting one for you today. First, as always, let's just start off with a quick recap of where all major markets are, along with my thoughts on the S&P 500. First, just looking at market color, we've still got downtrends in volatility and bond yields, also gold and energy, and importantly, inflation expectations. I'm going to get into some inflation data a bit later on. And whilst we're obviously still in a bull market, for the here and now, I think we may be getting a little bit technically overbought in the short term. I can see my reversal signals indicator firing off for the first time today. My DSI going into overbought territory. Trend strength is negative. Institutional buying is red. The last time we got some reversal signals, red institutional buying. Market was a little soft there for a few weeks. And back in late March as well, market rolled over a little bit there. Similar setup in the NASDAQ Qs. Starting to look a little stretched here. I can see we're 7% above 50-day VWAP. And as I've been pointing out recently, we don't have the market breadth internally in the States or globally as well to support a really healthy rally here. And don't get me wrong, I'm just talking about the here and now. We're obviously still in a bullish uptrend overall, but just looking at the S&P 500 equal weight, that's consolidating. And so is the Russell 2000 small caps, actually below the 50-day VWAP. Volume breadth isn't the best either, on the low end of the range. And we've still got that big divergence between long-term breadth and the market. And also new lows, once again eclipsing new highs in the market. Counteracting that, we've still got really low VIX and volatility. Still got bond yields pulling back, causing bond prices to break out to multi-month highs. High yield bonds still holding up well. Bit of a pullback in Bitcoin, which is not really correlating with NVDA and the NASDAQ too well lately. There's crude oil just pressing up against the 50-day VWAP. And there's a look at Apple, also looking a little stretched after a huge rip these last few days. Now back to being the largest company in the world too, by the way. However, NVIDIA is not too far behind. Also putting in another strong day, 3.5% higher, now at 3.19 trillion market cap, making it less than 100 billion away from overtaking Apple. And I've calculated that if Apple stays the same, to be around $134 a share in NVIDIA, or just another 3.4% higher than when we are today. So if NVIDIA can put in the same performance today, tomorrow, it will officially become biggest company in the world. And the other hot stock people are talking about, GameStop, finishing up 14.3% today, just above where the company got their latest share offering done. And we just got an update from Roaring Kitty on his Reddit account. As I suspected yesterday, he closed out all of his call options and, like I thought, added more shares. Previously held 5 million shares. Now he's got 9,001,000 shares. Current value around 262 million, with still 6.3 million in his cash account. And what's interesting is that's the exact same amount of shares held by current CEO Ryan Cohen way back in December 2020, 9,001,000 shares. Not really sure what to make of that. However, the dude is different, maybe leaving little clues, maybe trying to imply he's on the same path as Ryan Cohen. And who knows, the guy's good at playing options, holding stock when it's high, buying calls when it's low, parlaying that initial 50,000 into over $250 million. He very well could end up with more shares than Ryan Cohen currently has, 36.5 million. More importantly, the bigger, deeper play is he's allowed GameStop to raise a lot of cash while keeping the stock price elevated, really strengthening their balance sheet, basically pulling in shareholders all around the world to really back this company and give them a shot at actually making something. And so that's going to give shorts a real hard time. And we're already seeing some shorts starting to throw the towel in already. Like Andrew Left from Citron Research, famous short seller who initially targeted GameStop back in 2020 but lost big, and who regularly publishes hit pieces on numerous companies, causing their stock prices to dive. Very upset when Roaring Kitty came out on social media and was able to influence GameStop higher. Said he's no longer GameStop, and it's not because he doesn't believe in a turnaround for the company, but with $4 billion in the bank, they have enough runway to appease their cult-like shareholders, and he respects the market's irrationality. So in other words, Roaring Kitty is already eating the shorts, and he might only just be getting started. Moving on to economic data we got today and a look at the US economy and whether it's rolling over or not. We got some cracks happening underneath the hood. The jobs market, along with a softening in inflation. Is that the Goldilocks scenario the stock market wants? Or is it going to go a bit deeper into a recession? With the producer price index actually falling 0.2% in May from the prior month, a lot weaker reading than analysts expected. They thought it would increase by 0.1%. And so we get the Fed's preferred inflation gauge in 2 Wednesdays from now. Personal consumption expenditures, PCE, and along with that soft CPI print from yesterday, soft PPI print, got some soft jobs market. We very well could get PCE come in line with the Fed's 2% annualized target reading for the month of May. They got excited last time, late last year. We were getting some good prints. However, it shot back up, so it is pretty elastic. However, for the here and now, it's a good sign for inflation. And just like we can see in my spread of inflation adjusted treasuries versus normal treasuries, coming off pretty hard this last week and a bit over the last month as well. That's also showing up in 2-year US inflation swaps. For those of you who don't know, basically a swap is kind of exactly how it sounds. Normally done by really large players, institutions, JP Morgan, big hedge funds, things like that. And it's a transaction between two parties where one will pay the other party a fixed rate, and then the other party will pay back the first party a floating rate. So here in the 2-year inflation swap, currently at 2.32%, that's basically what their market's agreeing is kind of the over-under on the average inflation rate per year for the next 2 years. So if you were to enter a swap as a fixed rate payer, you would pay 2.32% to the floating rate party, and they would pay you back what the actual inflation rate comes in over the next 2 years. And it's often just the difference between the two that is settled on a monthly or quarterly basis. And it's just another way for big institutions to kind of hedge against movements in inflation. And you can also set up swaps and many other different markets as well. But the key point to take away is market expectations of inflation have significantly dropped this last few weeks. We also got weekly jobless claims today, which actually shot up, now getting back to the same level in August last year. And another sign of softening labour market conditions. The key industry of economic growth, trucking, moving goods around the economy. Year-over-year changes in truck transportation and private sector employment also turning back down, and a significant gap between the private sector as well, something we typically see going into recessions. However, don't worry, because US Treasury Secretary Janet Yellen says they are creating jobs at a very rapid pace. And she's not wrong. Just looking at all government jobs, they are creating them at a very rapid pace. However, looking at the real economy and full-time jobs, that's actually gone negative. And again, something we see going into a recession. And even though the unemployment rate is still under 4% for now, most people still employed, even if they do have 2 or 3 part-time jobs. What most people are grappling with isn't the month-over-month inflation changes that economists and markets care about, and we always talk about. It's that embedded inflation. And even though the 2-year percent change of food at home is coming down off that peak from 2 years ago, that's still a 7% increase in the cost of our food at home over the last 2 years. And looking at the 5-year change, that's still about 26% higher than 5 years ago before COVID. What's even worse is food away from home. I'm sure plenty of you are feeling that. Every time we go out to eat, seems the prices are getting higher and higher. 2-year change in food away from home, currently about 12.5%. And that's why we've got a growing trend of consumers saying they'll be doing less dining out. We can see how many people said that March last year, June, September, and March this year. Increasing amount of people said there'll be less dining out and less expensive dining out. In other words, consumers plan on pulling back a bit of their discretionary spend as they have been doing already. And so just looking at the market pricing of Fed rate cuts for this year, currently about 45 basis points of cuts. You can see at the start of the year, market was pricing in a whopping 170 basis points, 1.7%. It was thinking we were going to get cuts this year. It's completely repriced. Stock market didn't care, and you can see after each CPI just shot up, kind of flatlined a bit in April. Now the latest CPI has actually rolled over a bit, starting to price in that we're going to get that cut in September, while still given a possibility we could actually get it in July. And so we're getting down to crunch time for AAPL. The next few CPI jobs prints are going to have more weight than the last times. Getting closer to the election, the market's saying, hey, we think you're going to start cutting soon. Getting to a similar setup to late last year, we're getting some good prints on inflation. Is he going to jump the gun? Can we avoid a recession while still having a bit of high inflation? Or will we just get high inflation, high stock market, and be able to avoid a recession? Or could we get both? Stagflation, no economic growth, cost of our food is still high. So that's a bit of a softening macro data, jobs market. However, looking at the stock market and what big companies are making, doing pretty well. Earnings are up year over year, they're growing, analyst expectations are increasing. Even volatility in earnings per share is structurally lower. In the last recession we just had in corporate earnings last year, the smallest since the 70s and the 80s. Not only that, but looking at leverage of non-financials, their net debt to equity, relatively low levels compared to history. And I think that's what's really saved the economy and stock market this time, with rates being hiked. Many corporates and consumers locked in low rates going into 2020. Unfortunately, the federal government didn't quite do the same, selling a lot of short-term bonds instead of long-term bonds at 1%. And so they've locked in those low rates, and so the increase in rates. So a lot of people have been sheltered in the sharp increase in rate. However, that only lasts for so long. And stepping back again, looking at the whole picture, still got those pesky valuations. Looking at a long-term chart here, going back to 1871. In the red line, it's the S&P 500, adjusted for inflation. In the grey, CAPE valuations, 10-year PE. The only time we've been higher was back in late 21, the late 90s, and even at a similar level in the late 1920s. Every single time the market rolled over in the subsequent years. So is this time truly different because of structurally higher profit margins, dominance of US tech around the world, people's pension funds buying stock every single day, ultra loose monetary conditions and stimulus and backstops from the Federal Reserve? I think all of that does mean we have structurally higher valuations going forward. As always, it's a question of how much. So on many measures, the economy is cooling, jobs market is softening. However, I believe Jay Powell yesterday, he does need to see a few more good prints before he can go ahead and pull the trigger. And I'd say if we got 2 more good CPIs or PCEs, or especially an unemployment rate going above 4.1, 4.2%, I think he may just go ahead and cut in September. And I know that's a bit of a different view I had a few weeks ago, where I didn't think they'd be able to cut this year. However, you've got to adapt to the data, adapt to the tape, and I'm just following the market's cue here on its inflation expectations, and the fact we've had a huge pullback in oil. Like I said, inflation does correlate with oil pretty well. So if oil stays tame, then I think very well Fed may cut in September. However, that is far from guaranteed. It's just looking more likely after today. But as far as the stock market's concerned, that's music to the ears, and the bull rages on. Momentum well and alive at the index level, same with volatility. And we've even got big investors like billionaire Steve Eisman, trade in the movie The Big Short, said a recession isn't happening as the US economy is the most dynamic it's ever been in history. And you know, he's got a point. There is a real boom in artificial intelligence and the infrastructure needed to support it. That is real. American technology does dominate the world. Highly profitable, especially if they can continue the trend of firing people and replacing them with robots and machine learning, AI chatbots. It's already taking many jobs. For example, a lot of tools I use online. Up until recently, if I wanted to do a live chat, I would speak with a real human. Nowadays, I'm speaking with an AI chatbot, and they can pretty much do the job just as well, if not even better, because they can read all of the company's documentation, and instead of me digging deep through help docs, it can just give me an answer straight away for my technical question. And I think this is a trend that's only going to keep getting bigger and bigger. So we could be moving towards that dystopian world where we've got a handful of companies really dominating and running the economy, maybe even already getting to better credit quality than the US government. Maybe one day we'll start measuring the risk-free rate against Apple bonds instead of US Treasury bonds. And these big companies can continue making more and more profits while the unemployment rate structurally increases and we move towards universal basic income. And it appears the streets really loving Apple's move in this direction with telephones. And once again, Steve Eisman's saying, definitely hold on to your Apple position. It's too central a figure in the whole story. Again, he has a point. Apple, strongest brand in the world, biggest user installed base. They haven't created any of their own AI technology. They've used all their cash to buy back shares, and now they're just using other companies' AI technology and just wrapping it up in their own hardware products because they've got that huge leverage with having the hardware. And you could think of hardware as kind of like land, and the landlord has big influence, if not control, over what goes on in his land. That's why we've got Mark Zuckerberg and Meta pushing the Meta Quest VR headset, so he has the hardware advantage. Doesn't just want to run his software on Apple's Vision Pro. And like I said, I wouldn't be surprised if Elon Musk potentially comes out with an X smartphone to again give him the hardware advantage. We've seen him do this in social media, overtaking Twitter to control his voice, not go through a mainstream media filter. But for now, Apple is in the spotlight. No one's overtaking the iPhone anytime soon. They're way too dominant, and the market is very well pricing in growth for Apple next year, which it'll be disappointed if it doesn't see. Just looking at a lot of valuation metrics on Apple versus its 10-year history, most of them in the top decile of a 10-year range when it comes to price to earnings, price to sales, price to free cash flow. But that is some monster candles we've got this week in Apple with huge volume. Big institutions saying Apple is going to start growing again in the next few quarters over the next year or two. Because if it doesn't, it's probably setting up for a decent sized correction. So there's currently 6 companies in the $1 trillion club of market cap valuation, all mega cap tech. And the next one could be Broadcom. After it ripped up higher today, after good earnings, current market cap $778 billion. Other chip makers too, like Supermicro, bouncing back in a big way today, 12.4%, and ARM Holdings also breaking out, but like a few other stocks, starting to get a little technically stretched here in the short term. Some of my indicators firing off. And it's moving on to commodity. Good oil, pretty much flat, consolidating around the 50-day here. Didn't really react too much to that producer price index data. Also got gold, still consolidating. Agricultural commodities as a group, breaking out to a monthly high there. But just moving on to a big part of commodities and how they're priced and traded around the world, and just looking at the US dollar. Russia and China taking the lead, de-dollarization, a really strong-willed and long-term pursuit to get off the US dollar reserve and from trading in US dollars, having to receive US dollars in exchange for oil and goods. And we just saw another development with Russia's Moscow exchange halting dollar and euro trading in response to further sanctions from the US. Now, the Russian stock market's not that big, so this is not a huge deal in itself. It's just another step away from the dollar. And we've also been hearing reports that Saudi Arabia is going to end their unofficial petrodollar deal with the US, in which basically they receive US dollars in exchange for selling their oil, and then they take those US dollars, typically buy US treasuries or other US financial assets. Helps to keep stability in US financial markets, allows the treasury to get away with lower yields, good valuations for stocks, real estate. It also gives the US immense leverage over other countries, because if they don't do what they want them to, they'll lever them with sanctions. And that's to the dismay of a lot of the world outside the West. Now got the BRICS. Originally, Brazil, Russia, India and China on a strong path of expansion, adding new members, South Africa, Saudi Arabia, and have even received written interest from 34 other countries who want to join. Also seen Iran, Egypt, Ethiopia, United Arab Emirates come on as full members. Argentina was going to go that way, however with Malay, he decided not to. Going to keep siding with the West for now. And they do have a cohesive group, the BRICS. They've already set up a formal and official de-dollarization program with the main goal to get off the US dollar, which for a long time has dominated global finance and international reserves. And they're already planning their own currency, backed by all of their own local currencies, which they may actually launch this October at the BRICS Summit. And a lot of people still think a lot of these BRICS countries are third world, backwards, not really much happening there, but I think a lot of people may be surprised at how developing they are, especially China and its move into robotics, automation. But just looking at its stock market, you wouldn't think so. But the actual economy itself is ripping and roaring, still growing 5% a year. And we're also seeing similar developments in India, really starting to grow leaps and bounds and actually catch up to the West in a lot of key areas, not to mention military strength as well. So they definitely shouldn't be underestimated. And this big tectonic change happening in the world. And in fact, on some measures, it's already happening. Just looking at the share of global GDP at purchasing power parity of the BRICS nations last year represented 32% of the world, whereas the G7, made up of the States, Japan, Germany, Italy, France, United Kingdom and Canada, only coming in just under 30%. And that gap's going to continue closing. Just looking at the International Monetary Fund's World Economic Outlook for GDP growth this year. Looking at Western nations, G7. America out in front at 2.7%. Rest of the West, pretty low economic growth. But look at the BRICS. India, 6.8%. China, 4.6%. Many others, above 3%. They're growing a lot faster than we are. And like I said, they have a strong will to deliver from US and what many have considered as very aggressive foreign policy, levering sanctions onto them, or at least being made to feel vulnerable that what's happened to other countries around them may happen to them, especially when the US government issues sanctions onto other countries, accusing them of weaponizing their legal systems against political opponents. And so what we've seen recently isn't really a good look, and some consider a bit hypocritical. And so it's a bit of a split world we're in now, especially since a lot of these countries are autocracies, and here in the West, we're largely democracies, even though it's mostly corporate-sponsored democracies. It is a bit of a fight between democracy and autocracy, and so hopefully the West as a whole can stand our ground and don't get overtaken by the BRICS one day, especially not in terms of military strength. And like some say, first you need to clean your own house before you go and try and clean someone else's. And just to be clear, the US dollar reserve is not going anywhere anytime soon. This is a long-term trend that is still yet to be seen exactly how it's going to play out. Moving on to the other big news story of today, Elon Musk. Shareholders voted in his favor, reaffirming their support for him and upholding the original pay package that was already agreed upon, promised to him, all of which conditions and benchmarks he met, helped the company immensely, created a lot of wealth, and it looks like that judge in Delaware has got egg on her face now because her judgment's been completely reversed. The net result is Tesla, along with many other companies who have followed them, have relocated their headquarters out of Delaware into Texas, where they feel much more protected by the upholding of law. And even though the company has to pay Elon Musk a lot of money, stock market liked it. Gapped the stock up today, did sell off going into close, but still finished up almost 3%. I think the market just likes the fact that Elon is still likely to have big leverage and influence and control over this company going well into the future. Just like we're seeing Oracle, Broadcom, some of these other old big tech companies starting to come back, we've got Adobe soaring today on better than expected earnings, beating street expectation, growing revenue 10% year over year, and the stock had been in a bit of steady downtrend these last few months. Closed today at 458. However, just going to the post-market session, it's ripped up a huge 14% going into post-market close. And this was trading in a similar manner to Salesforce, which had also been in a downtrend. They actually beat a little bit on expectations, gave a slightly softer outlook. The market punished them. It's tried to bounce a little bit, but still seems to be under some pressure here. And we've got a new ETF on the way, the Tuttle Capital Congressional Trading ETF under ticker NPEL, which is short for Nancy Pelosi, and again just shows you what a bit of a joke the stock market is. We've now got a fund that makes trades based on following the trades of congressional members. In other words, we're trying to jump on the back of Inside. However, that's the way it is, and this is not the first ETF named after Nancy Pelosi. There's already one on the market under ticker NANC, and believe it or not, it's actually been performing really good since it was launched a bit over a year ago. There's a look at Fed Fund futures after PPI data today. Currently pricing in almost 70% chance they're going to cut in September, another cut in December. Fear and greed index in the fear zone as the S&P 500 sits at all-time highs. Really strange divergence thanks to that really bad market breadth. Corporate insiders not doing a whole lot of trading either. Worst performing sector today was gold miners, still a bit soft here. Best performing sector, semiconductors. Thanks to the rip in NVDA still really going out on a bit of a lone island there though. And there's cannabis, MSOS. Looks like we got that break today I was talking about. Wasn't sure whether it was going to be up or down. The market was coiling up in an oversold territory. The DSI was flat, wasn't really giving us a divergence. Looks like we've got the break down. There's two ways to look at it. Of course, it's never nice to see your positions go down. We all want them to go up every day. However, that's not the reality. The other way to look at it is it could be offering up another buy the dip opportunity, and we'll see whether we can still hold this 730, 720 area. Otherwise, the next big key area of support is going to be around 650 down to 6. And so like I've always said, this is a really messy, volatile ride. We've still got a number of key fundamental hurdles to jump over: safe banking, full legalization, and hopefully we get some more positive developments from the Biden administration on this topic going into the election. And there's a look at the world's biggest bank, JP Morgan, just holding ground there a bit today. Okay, so that's a wrap, guys. Just to summarize, I think we're getting a little stretched here in the short term. Maybe we see NVIDIA become the biggest company in the world tomorrow, and that could mark a bit of a line in the sand where the market may put in a short-term top. Do we have really weak breadth? Counteracting that, options market's not really worried. Bond yields have pulled back. Oil's kind of tame. And like I show you today, we've really got changes in inflation expectations pulling back, which should be very supportive for the stock market. Still think the medium uptrend is intact. Just in the short term, we may be getting a little overcooked here. Anyway, that's all my opinion. I'm always interested to hear your thoughts on current events in the market. You're welcome to drop a comment below this video as I reply to everyone. Thanks very much for tuning in, and I'll see you all again tomorrow night. Cheers.